TV18.
Hello and welcome to the CNBC-TV18's Mumbai Newsroom. I'm Sonal Bhutra and with me is Pavitra Parekh. You're watching Mutual Fund Corner. You know, Pavitra, there's been so much action in the mutual fund space in the last couple of days. That's all that we've been talking about. So today, let's talk about multi-asset funds because we spoke about how the indexation benefit has been taken away from debt funds. The tax rate is now marginal rate. So is it a good time to look at something like a multi-asset fund? What are the other categories can investors look at? And specifically understand more about multi-asset funds as a category and a lot more options. So we have just the guest for that today.
Oh, absolutely. So let's get straight to that. And, you know, we have lots of questions as well. So before that, let me welcome our guest on the show. Amit Bivalkar is founder and director at Sapient Wealth Advisors and Brokers, and he joins us now. Amit, thank you very much for taking out the time and speaking to us today. You know, like Sonal was pointing out, there's been so much action in this space. We saw that, you know, amendment come through to the finance bill. The big indexation benefit has been taken away. Debt funds will be taxed at, you know, the marginal rate or the slab rate. In this context, what should an investor do? Are there other, you know, categories of funds that you think they can look at in order to try and get a benefit that perhaps now they've, you know, considering that now they might want to move away from the debt category?
Yeah, thank you for having me on the show. And the taxation impact actually was just one of the benefits what a debt mutual fund actually offers. If you try to look at what a debt mutual fund offers is the pure deferment of tax until you have redeemed your money. Unlike fixed deposits where your interests get accrued and you have to pay tax on that every year, while in a debt mutual fund, till the time you don't redeem, you actually do not pay any tax. Second important advantage is that you have diversification, which is not possible in a fixed deposit. The third one is that you can redeem partially. If you have invested ₹1,00,000 and you need 5,000, you can actually withdraw 5,000 and the rest can keep on growing. The fourth most important point is that there is no reinvestment risk in a debt fund. In a fixed deposit fund, when you get your money back, you don't know what rates will you get when you reinvest that money, while that is taken care of in an open-ended mutual fund. So apart from all of these, there was a tax exemption by way of indexation, which was available to you for the last 12 years, which have been taken away. And I think it should not make any more difference because if passive income gets taxed like active income, I think we are at par with fixed deposits, but with those 5-6 characteristics, we still score better than a fixed deposits over a long period of time.
So, Amit, that's a different opinion that we are getting. So, are you saying that despite this indexation benefit going away, there's still a preference more for debt mutual funds versus a fixed deposit?
Yeah, if you look at the long end, like 5 years, 10 years, and asset allocation makes an important point here that if you want to put money in debt and which is a part of your asset allocation and which is going to stay in perpetuity, then I think debt mutual funds score very high over fixed deposits because the open-ended nature of the mutual fund actually takes care of your reinvestment risk. Also, Sonal, what we have been showing to the viewers here is that if you do a withdrawal of appreciation from debt mutual funds, then your effective tax actually comes down to mere 2-3%. And how is that? Because mutual funds operate on a first in, first out basis, wherein you redeem X amount, that amount includes your principal as well as appreciation. And therefore, your overall tax in percentile terms comes down to only 2-3%. So people who want a regular income, even from a debt instrument, if they do a systematic withdrawal plan from a debt mutual fund, post-tax basis on a yearly basis, you will be much more better than a fixed deposit. As regards high net worths and corporates, they are mostly in the less than 3-year segment because of liquidity requirements, and that segment was any which case taxed at the marginal tax rate earlier.
Amit, you know, I completely take your point where you're saying that these, you know, these are other factors to consider, and it still perhaps is better to look at a debt fund over a, you know, fixed deposit. And we haven't talked about this as well, that in this category, it is really the HNIs or institutions which are larger holders. It's not so much retail. For a
Yeah.
retail investor, because we're trying to reach them as well through this show, sometimes it just sounds easier to go for a fixed deposit, right? When there's this kind of big change going through. And, like how HNIs would have advisors at constantly, maybe a retail investor does not have that. I think that's the key difference here. But tell me more from a retail investor point of view. Do you think something like a multi-asset fund could be a good alternative if they are sort of a little bit shying away from this debt category? Because multi-assets are also hybrid funds and they will still get exposure to debt.
Right. So a retail investor probably is not in the highest tax bracket. That's point number one. Point number two is that definitely a fixed deposit for a retail investor will make sense, although he must look at the credit in which he is investing. So for that, you need a mutual fund manager who can look at the credit of the companies where you are investing. Multi-asset funds actually is a category which has been ignored for long. If you look at multi-asset funds, these funds typically have a 3-asset table wherein they invest in equity, they invest in debt, and they invest in gold or commodities, precious metals or commodities as well. Now, if you look at multi-asset funds, these funds actually are termed as hybrid funds, and these have the maneuverability between 3 asset classes, which is equity, debt, and gold. According to the offer document, they can invest at least minimum 10% in all these 3 asset classes. The big advantage here is that if you try to compare it with, say, an index, say a Nifty 50, or if you try to compare it with a gilt fund index, then over long periods of time, there is a CRISIL index since 2002. If you try to put out a comparison of this index versus the market, that is Nifty 50 benchmark, then you will see that multi-asset funds gives you very low volatility compared to the market. They give you very less drawdowns when the market actually falls, while they give you a superior risk-adjusted return, which is your Sharpe ratio. So on the return front, they are as close to a market return over long periods of time. But on the risk-reward ratio, these funds have delivered actually better. Also, these funds are taxed as equity. So you don't need to pay marginal tax rate, but you can get away with a 10% on a long term and 15% on a short term below 1 year, because it is categorized as an equity fund.
Okay, interesting. And you have very helpfully helped us with the table as well, where we are talking about returns for CRISIL Dynamic Gilt Fund at 7.87%, domestic price of physical gold, the return there is 12.12%, and here in the multi-asset funds it's 13.53% versus Nifty, which is 13.93%. So of course, as you pointed out, lower risk or lower volatility but higher returns is what these assets or these funds provide. I mean, that takes me to the next question. While returns are higher, the second thing why one would look at multi-asset funds is the taxation bit that we spoke about in debt. What is the other case for buying into such funds other than the change and the returns as well?
So first of all, you should buy into such funds only if your risk profile actually provides for. This is not an alternate to debt funds, but this is for people who want a combination of 3 asset classes and over long periods of time want their capital to grow. So people who are looking at an exposure of precious metals, people who are looking at an exposure of debt, and people who are looking at an exposure of equity as a combination with equity taxation should definitely go in for multi-asset. Let me tell you, when inflation is high, you will always feel that equities will do well. So this fund points to do that. When interest rates go up, your debt actually does well. So this fund helps you in that as well. And when there is probably a crisis in the world or in stock markets, you have got precious metals or gold in multi-asset, which actually protects you. In fact, that's a classic inflation hedge, and that's a classic flight to safety kind of investment avenue. So if you look at all 3 as a combination, then you can get equity flavor, you can get the safety of debt, while you can get the precious metal also with equity taxation. And therefore, people are going in for multi-asset funds.
All right, that makes a lot of sense. So far, we were talking to a lot of experts about, and, they were telling us how you can perhaps look at a balanced advantage fund. But this, of course, would also be a great sort of not alternative to debt funds, but would give you exposure to all three at least. Amit, it's been a great chat, but I request you to please stay on because we need to get into a quick break. When we come back, we have lots more questions and we're going to continue our discussion.
After a career spanning over 3 decades at Unilever, Sanjeev Mehta is ready to hang up his boots.
There is nothing like a holy cow. You can challenge everything.
Hindustan Unilever has doubled its revenue in the past 10 years that Mehta has been in charge. Its market cap has grown 5-fold. On the winning mindset this week, we take a look at the legacy of Sanjeev Mehta on Hindustan Unilever and India's retail landscape.
First is the culture, is the high performance culture. It is a culture where we have brought in the owner's mindset. It is a culture where we have delegated to the edge. We have reorganized our business.
Catch the winning mindset at these times only on CNBC-TV18.
ना इधर ना उधर, इस बार टाटा IPL सिर्फ जियो सिनेमा पर।
तू जब तक चैंपियन बनेगा ना, इसका रंग उतर जाएगा। रंग उतरा? ये रंग तो वैसे भी उतरने वाला नहीं था।
बारिश, धूप और धूल से आपके घर को सालों साल बचाए। ड्यूलक्स वेदरशील्ड पावर फ्लेक्स, घर का चैंपियन।
Helps beat sensitivity fast. Sensodyne Rapid Relief.
खुद पीछे रह जाएं चाहे, देश को आगे रखते हैं। छोटे छोटे हो चाहे पर नेक इरादे रखते हैं। आंखों में एक आस लिए ईमान पर चलने वाले लोग, देश चलाते हैं सारा ये आम से दिखने वाले लोग। आइए करते हैं देश चलाने वाले इन्हीं राइजिंग हीरोज का सम्मान। न्यूज़ 18 राइजिंग इंडिया, रियल हीरोज।
Presented by Poonawalla FinCorp Limited, enabling dreams.
कैसे करते हैं ट्रेड? Drive 5 पैसा। Upcoming corporate action या news flow, किसका हुआ merger, कौन है नया CEO?
Financial data मिलेगा अब हाथों हाथ, fundamental analysis से अब बनेगी बात।
जानो हर stock जो है trendy, technical analysis से भी लगेगी friendly। Quarterly results होगी send, luck by chance investing का होगा the end।
With 5 पैसा's in-depth company information, always stay up to date.
ऐसे करते हैं trade।
सोच मत छोटे, install मार। Investment in securities market are subject to market risk. Read all related documents carefully before investing.
सुशासन विकास रोजगार, डबल इंजन की सरकार। मोदी योगी की मेहनत से बदला आज नजारा है।
खुशहाली के एक्सप्रेस वे पर बढ़ता राज हमारा है।
यूपी की रफ्तार देख कर बोली दुनिया सारी, 6 वर्षों का काम दिख रहा 60 साल पर भारी।
6 वर्षों का काम दिख रहा 60 साल पर भारी।
कांप रहे अपराधी डर से, छटा घोर अंधियारा है।
खुशहाली के एक्सप्रेस वे पर बढ़ता राज हमारा है। खुशहाली के एक्सप्रेस वे पर बढ़ता राज हमारा है।
सुशासन विकास रोजगार, डबल इंजन की सरकार, 6 साल यूपी खुशहाल।
अब ब्रोकर के पीछे भागने के दिन गए।
घर रेंट करना कितना इजी हो गया है।
नो ब्रोकर,
नो ब्रोकरेज।
फ्री में घर लिस्ट करो और आपका नो ब्रोकर रिलेशनशिप मैनेजर टेनेंट कॉल से लेके पेपर वर्क तक सब देख लेगा। तो ब्रोकरेज क्यों देना? नो ब्रोकर है ना।
Show me the sunset, you make me happy, we wanna go there, it's beautiful.
Magnite. Be celebrated with the big, bold, beautiful Nissan Magnite.
Hey guys, welcome back. You're still tuned into Mutual Fund Corner and we still have Amit with us. He's director at Sapient Wealth Advisors and we're talking all about multi-asset funds after the recent sort of amendments that came through, and if it makes sense to really move from debt funds and look at this asset class, this category of funds as well. Amit, since we were talking about multi-asset funds, you have taken us through a little bit about, who it's suitable for if you are looking at this diverse basket of assets. But tell me specifically from a new investor perspective, say someone is just getting into the markets. Do you think this is a good bet to take? Because, like you said, it does give you exposure to these three different classes.
So, as we say that you have a triple Sunday in ice cream, this fund actually is like that, where you have a equity, debt as well as a precious metal option.
Yeah.
But for a new investor, it's always better to graduate from a lower equity exposure to higher equity exposure, because this is all expectation management of the investor. So when you are going into a mutual fund for the first time, I think by tiptoeing into a fund like a ESF category or a MIP category, which has a 15% to 25% equity, then you have got a balance advantage fund category, which can go from 35% to 65% equity. And then you have got multi-asset, which gives you really a combination of equity, debt, and gold. I will say that investors have to gradually step up their equity exposure, because in this, you don't need to have shocks, because it's your hard tax paid money, which you should invest into the market over long periods of time. So increase your equity exposure slowly and gradually. But if you're confident of doing an asset allocation product and keeping it for long periods of time, you can straight away come into a multi-asset fund also.
So one should move from vanilla, then to strawberry, and then go to a three-layered sundae, right? You've gotten both of us definitely hungry here in the studio, Amit.
The new investor doesn't want to start with vanilla. We want the chocolate right at the beginning, right? That's what we always talk about.
No, but yes, jokes apart, Amit, that's a very helpful advice, of course, for new investors who are investing for the first time into the markets. I missed this point, so I wanted to just ask you again as to how these funds are taxed, because at the end of the day, it's all about post-tax returns for an investor.
Right. So the multi-asset category maintains 65% equity as required by SEBI. It is a combination of long equity plus arbitrage. So they maintain 65% equity, which is a SEBI requirement. If you are qualifying into that category, you are taxed as an equity mutual fund, and therefore you will have 15% short-term tax while 10% long-term, as it is applicable to a normal equity diversified or any equity related fund. So this is a big advantage for people, because you get three asset classes, yet you get the taxation of equity, and therefore this taxation will definitely help the category.
Okay, that point is completely taken. Amit, we were talking to some wealth managers this morning as well, and they said that they're already seeing a very sharp rise in this sort of money moving to debt funds before that 31st, before the rules change on the 1st of April. So in these 3-4 days, they've seen the flows into debt funds really pick up. If you think that there is someone who is, who was anyway considering getting into this space, do you think it makes sense to just make a run for it and do it before 31st?
So absolutely, I think people in the highest tax bracket, one can look at open-ended funds like banking PSU, as well as corporate bond funds, and the dynamic bond funds or the all seasons fund, wherein in a all seasons or a dynamic fund, you can definitely have the fund manager adjusting according to the interest rate movements, while a banking PSU or a corporate bond category today are at a 3-4 year duration. So if you look at a banking PSU, then they are ring-fenced for credit. If you look at corporate bond, they can go and buy into credits, and hence you can have a higher accrual. While if you look at dynamic bond funds or all-season bond funds, you give the fund manager flexibility to move the duration as and when the interest rates move up or down. So if you are in the highest tax bracket and if you want to take benefit of indexation, then clearly before 31st March, you need to move your money into long-term debt funds. I am not a great fan of target maturity funds or long-term fixed maturity plans, because you end up with a reinvestment risk and you end up with a fixed taxation at the end of the tenure. Therefore, I'll prefer an open-ended fund, which will automatically readjust itself and you keep on deferring your tax.
I was just going to ask you about target maturity funds, but you made that very clear. This is not something of a category that you would look at. So in a scenario like this, since we have you with us, we just don't want to be talking about multi-asset funds because you can enlighten us with more on the other side as well. Considering the kind of markets that we are in, we have been choppy, there's a lot happening in the US as well. What are you telling your clients in terms of mutual fund investments, something that our viewers can take note of as well? What is the best category according to you, or something that would be at least better than the others?
So it's very difficult to pinpoint to a category that this will do well over the next 1 or 2 years. I think what is critical is one has to understand that interest rates moving up definitely is bad for equities. If you see inflation still moving up, inching up, you will have interest rates following it. And therefore, you will have some kind of negative or flat returns in equity over the next year or so. But this again becomes an opportunity to nibble equities, wherein you can start deploying as a systematic transfer plan or an SIP for the next 12 months, wherein you can take exposure into equities. Remember, when others are fearful, we have to be greedy, and when others are greedy, we have to be fearful. 1.5 years, markets have given you flat or zero returns, and therefore people are losing their patience. In fact, people who stay the course and in fact add more to SIP now, in the next 3 to 5 years, they will see this effect of compounding coming in, because when the markets are flat and the fund is not delivering, you actually accumulate more units. And that is what will help you over the next 3-5 years when the NAV moves up and you get a handsome return. So if you have that in your mind, inflation is sticky, interest rates moving up, you might see a 6 to 12 month period of flat returns. But keep your SIP going, add more to your SIP, do a STP now in equity, and you will reap the benefits over the next 3-5 years.
Oh, absolutely. That point is well taken. And this is something that we've tried to highlight several times on this show, that, you know, especially in mutual funds, you hopefully will get in with an idea of looking at it from a slightly longer term perspective. So even if markets are range bound for a short term, it shouldn't matter too much. Amit, you know, we were talking about new investors. You did bring up some of the sort of risks that they should keep in mind as well. A lot of experts talk to us about index funds for new investors. Do you think that's a good way to go? And are there any other categories which you just feel would perhaps be good starting points for an investor?
So index fund is the, what you can say, a no-brainer when it comes to equity, because it will mimic the index and you will get an index return minus the tracking error and the expense ratio of the fund. But I always believe that the fund manager and all the fund managers in India have actually beaten the index over long periods of time. And therefore, if you want to do investments for 5-10 years in equity, then an open-ended diversified equity fund will always beat the index and therefore the index fund. As a category, I feel that one should be more tilted towards large cap, or one should be more tilted towards flexi cap rather than a mid and small cap category. Flexi cap gives you a flavor of large, mid and small, all three, but it is more tilted towards large cap. So if you believe in the blue chip companies of India, and if you have 5-10 years of investing, I think the flexi cap fund should do the trick for you over a long period of time.
Amit, it was a pleasure having you with us on the show today. A lot to talk about, and you answered all of that patiently for us. So thanks a lot for joining us on Mutual Fund Corner on CNBC-TV18. And with that, we have run out of time on this edition of Mutual Fund Corner. Stay tuned for Closing Bell to take you through the last hour of trade.